The last slide covered by James looks to the future. But what can we learn from the past that helps form our view of the future? Well, the first thing to say is that the logistics sector is relatively young. It emanated from the former industrial estates, and post-millennium has increased dramatically in its sophistication and impact on our lives. Back in the 1990s, some of the largest buildings in the UK were around 350,000 square feet, often single height facilities. But since then, building sizes have grown substantially, with ground floor areas pushing 1 million square feet and eaves heights up to 30 meters, providing the potential for several mezzanine floors and several million square feet of space, and in turn providing flexibility, of course. Logistics has grown in importance, has become increasingly complex. Buildings provide different functions in the supply chain, and this is evidenced by the language used to describe building functions, from mega warehouses to smaller last mile facilities. Much of the market supply and demand data is bundled up and reported for buildings of over 100,000 square feet, as Kevin mentioned in his presentation, even though these properties can be very different in size and in function, again touched on by Kevin. The language used can therefore potentially be misleading, and this is something that the property profession needs to improve upon. On a number of occasions recently, we've been approached by investors concerned at market rumour that there's been a marked increase in speculative supply of big box logistics assets, believing that these relate to the larger scale buildings. The facts show the opposite's true, with speculative development of larger scale logistics reduced by around 50% in 2019. The page we're on here focuses on larger scale logistics of over 500,000 square feet. The left-hand graph showing that speculative supply of larger scale logistics over the last 4.25 years, since the beginning of 2016. And this shows that there have been only 8 speculatively constructed buildings completed since that time, totaling 4.3 million square feet. And of these, only 2 remain available today, totaling 1 million square feet. To put these numbers in perspective, total lettings in this size band over the last 4.25 years been nearly 44 million square feet. Speculative supply has therefore constituted less than 10% of take-up. Turning to the graph on the right, we're looking at the nature of lettings. What we note is that the second-hand space is limited, largely because the larger buildings are typically modern and in demand, but also because larger scale buildings tend to be built to suit. In other words, they're typically built following a pre-letting. This doesn't mean that they're bespoke. In fact, they're almost always designed for generic appeal. The takeaway here, however, is that the majority of supply for larger scale logistics is being absorbed by design and build demand. On this next slide, we focused on comparing the data for the different size categories of buildings. We're of the view that the full range of logistics property sizes are attractive, and we have in-house capability of delivering buildings in all these size bands following our acquisition of DB Symmetry. But we also believe that the larger scale buildings have some very attractive attributes. Firstly, can't have the last mile without the first mile. The larger scale buildings are usually a critical component in the supply chain. We've noted that significant levels of automation are rare in small buildings, which tend to handle lighter, faster moving products. Automation can be very expensive to install, as Kevin mentioned, the cost of which is typically paid for by the tenant and amortized under their accounts over a long period. The importance of the building within the operations of the occupier is also reflected in lease length. And we've noted a relationship whereby smaller buildings are typically let for shorter lease terms compared to larger buildings, which can attract leases of up to 30 years. Perhaps most importantly, there is also a correlation between lease length and tenant covenant, with the more financially robust companies attracted to larger scale logistics hubs. So with that in mind, in the left-hand graph, we've looked at market activity, combining take-up with the buildings under offer at the year end to form an impression of demand. What we find is that larger scale logistics buildings have been responsible for an increasingly large share of market activity in each of the last 4 years as a percentage of the total, rising from 35% in 2016 to nearly 50% in 2019. This compares with smaller category buildings, which have been responsible for a decreasing share of demand activity. The 2019 figure also includes over 8.8 million square feet of buildings which were under offer at the year end. COVID-19 has clearly slowed lettings, but the Q1 take-up numbers are impressive, with over 4.9 million square feet in 5 larger scale logistics buildings let since the turn of the year. The right-hand graph looks at supply by size band, with the y-axis denoting the amount of space as at the end of each of the last 4 years to the end of 2019. The amount of supply is also shown as months of supply in the small bubbles you can see there, compared to the run rate of take-up. In other words, 12 months of supply would suggest supply and demand parity. Notably, the supply of smaller buildings proportionate to demand has been rising, whereas for larger scale buildings, this has remained relatively low, and at the end of last year constituted only 1.4 months worth of supply against 12 months worth of demand, the shortfall being met by pre-lets. Developers are seldom willing to speculatively risk the capital required to construct very big buildings in a single location. When demand is strong, they prefer to wait for a pre-let. They're more comfortable speculatively constructing smaller buildings in a geographically diverse nature. This is borne out by the data. The smaller 100 to 250,000 category, there was 9.3 million of speculative development in 2018, of which 2.9 million was let last year. Sorry, let in that year. And in 2019, 56 logistics buildings were speculatively developed, totaling 8.1 million square feet. So a slight downtick, of which 3.4 million was let during the year. So leaving a fair amount of space unlet. So what does all this mean, and how do we interpret the backdrop of our market and the opportunities looking forward? And there are clearly opportunities and threats. The near term being of less clarity in our view. So I think the first thing to say is that logistics property looks to be the most resilient of all commercial property sectors during COVID-19, underpinning the continued operation of the economy, delivering higher rent receipts and maintaining more stable asset values so far. COVID-19 has accelerated the growth of online adoption with increased penetration across all ages and demographics, as James mentioned, and habits are likely to stick, with healthy levels of increase being maintained in a normalised market. There's likely to be a near-term lull, but post-COVID, we expect to see increased levels of occupational demand from occupiers for many of the reasons mentioned by Kevin. Larger scale logistics have been responsible for an increasing share of demand activity, and we expect that trend to continue as occupiers strive to benefit from economies of scale, reduce costs of unit per sale, and maximising capacity. Brexit and COVID-19 are expected to reduce reliance on overseas product sourcing, and that was a point that Kevin mentioned, and increase self-reliance, resulting in increased domestic demand for production and warehousing facilities within the UK. And this is something that we're already seeing coming through in the language from occupiers in our portfolio. COVID-19 has highlighted an additional benefit of automation, with lower staff interactions, allowing businesses to continue operations during lockdown. We expect continued investment in automation in order to capture operational efficiencies, improve stock control, and optimise delivery times. And with a UK recession now likely, investors are seeking resilient sectors with modest capex commitments low LTVs with an attractive cost of debt and high quality, reliable income. Despite the near-term uncertainty, the outlook for our sector is incredibly positive. An increase to 50% of online sales will result in an additional demand of over 150 million square feet, purely from e-commerce. We see the potential for strong demand-led growth, both occupationally and from investors. And against this, supply will continue to be constrained due to planning, benefiting those with advanced land platforms. That concludes our presentation for this morning.